In the pulsating heart of global finance, a vast web of transactions unfolds every second. Welcome to the stock market, where dreams are realized and fortunes are made. The essence of the stock market. Throughout history, humans have thrived on trade and exchange. From ancient bazaars to today's colossal stock exchanges, we've always been merchants at heart. In this vast ecosystem, businesses and dreams intertwine, each share telling a tale of aspiration and belief. The stock market represents the evolution of these trading spaces, but with amplified complexity and scale. It's not just about buying and selling, it's about researching, understanding, and forecasting. Predicting the next big trend or discerning a company's future potential can be the difference between monumental success and regrettable failure. But why are stock markets essential? At their core, they're platforms for companies to raise capital. As businesses expand and seek funds for projects, they turn to public markets, offering ownership slices to those who believe in their vision. For the investor, this market presents opportunities and challenges. It's a dynamic world where companies' fortunes rise and fall, influenced by global events, managerial decisions, and technological disruptions. Deciphering these patterns, understanding their implications, and making informed decisions is the crux of successful investing. The building blocks, stocks. When we think of stocks, we often visualize numbers, charts, and tickers. But behind these symbols lies the essence of a stock, ownership. To purchase a stock means buying into a company, believing in its future, and aligning with its mission. This ownership isn't merely symbolic. Shareholders, regardless of how many shares they possess, are company owners. They enjoy benefits, from potential dividends to voting rights. When a company prospers, so do they.
Sides? $26,000 worth of sides? What are these sides? They cure cancer?
Downturns affect their investments too. These rights, however, come with responsibilities. Active shareholders engage with company management, participate in annual meetings, and vote on crucial decisions. Their voices, collectively, shape the company's trajectory and influence its choices. Stocks, however, aren't uniform. They vary based on company size, sector, region, and growth potential. From the steady behemoths of established industries to the nimble startups disrupting markets, each stock offers a unique narrative and risk-reward profile. Navigating the marketplace. Every investor, novice or veteran, must grasp market cycles. Like nature's seasons, markets too ebb and flow. Bull markets symbolize growth and optimism. During these phases, economic indicators often surge, corporate earnings grow, and investor sentiment remains buoyant. In contrast, bear markets usher in caution and pessimism. Characterized by dropping stock prices and slower economic activity, these phases demand resilience and strategy. They test an investor's patience, often prompting them to reevaluate their portfolios and strategies. Yet, these cycles, while influential, shouldn't dominate decision-making. Short-term market movements can be volatile, influenced by fleeting news or sentiment. Wise investors differentiate between transient trends and fundamental shifts, making decisions anchored in research and analysis. It's also crucial to recognize the influencers of these cycles. From central bank policies to geopolitical events, myriad factors sway market directions. Understanding these allows investors to anticipate shifts, adapt strategies, and position their portfolios optimally. Diversifying your portfolio. If investing is an art, diversification is one of its foundational principles. A well-diversified portfolio spreads risks across asset classes, sectors, and geographies. It's a defense mechanism against unforeseen market shocks, ensuring that a downturn in one sector doesn't sink the entire portfolio. But what does diversification entail? At its heart, it's about balance. While equities or stocks offer growth potential, bonds provide stability. Real estate presents tangible assets, and commodities like gold act as hedges against inflation or economic uncertainty. This strategy, however, isn't static. As markets evolve and personal financial goals shift, so should diversification strategies. An early career investor might prioritize growth, skewing heavily towards stocks. But as retirement nears, they might pivot to bonds or fixed income for stability. Diversification also extends beyond asset classes. Within equities, for instance, diversifying across industries, company sizes, and regions can mitigate risks. It's about building a portfolio mosaic where each piece complements the other, crafting a holistic investment picture. The digital revolution. The digital age has revolutionized stock market participation. Today, a person in Tokyo can effortlessly invest in a Silicon Valley startup, thanks to online platforms. This democratization has broadened market access, bringing a global investment landscape to one's fingertips. But this revolution isn't just about access, it's about information. Real-time data, advanced analytics tools, and global news are now available instantaneously. This information symmetry levels the playing field, empowering retail investors to make informed choices akin to institutional players. Yet, with this information abundance comes challenges. The sheer volume of data can be overwhelming, leading to analysis paralysis. Furthermore, the digital realm, with its forums, blogs, and social media, can echo chamber sentiments, sometimes amplifying market myths or misconceptions. The key, then, is discernment. Digital tools, when used judiciously, can offer unparalleled insights. But they should be complemented by critical thinking, ensuring that decisions are based on logic, research, and individual financial contexts rather than prevailing online sentiment. Crafting a strategy. An effective investment strategy is akin to a well-charted map. It outlines the journey, considering current locations, desired destinations, and potential roadblocks. This strategy isn't a rigid doctrine but a flexible guide, adaptable to changing terrains and unforeseen detours. Crafting this strategy demands introspection. It begins with understanding one's financial goals. Are you seeking capital appreciation for early retirement? Or consistent dividends for passive income? Each goal necessitates distinct approaches and asset allocations. Moreover, it's essential to recognize one's risk tolerance. Not every investor is cut out for the volatile swings of high-risk, high-reward stocks. Some might prefer the slow and steady growth of blue-chip companies. Knowing one's risk appetite ensures alignment between strategy and comfort levels. Continuous learning further refines this strategy. The financial landscape is ever-evolving, with new asset classes emerging and older ones transforming. An adaptive investor stays abreast of these changes, continually tweaking their strategy to optimize returns while mitigating risks. Recognizing pitfalls. The stock market, while offering boundless opportunities, isn't devoid of pitfalls. Every investor, at some point, faces challenges. Recognizing these early can be the difference between minor setbacks and significant losses. Emotional investing is a common trap. Market downturns can induce panic, prompting hasty sell-offs. Conversely, booming markets might instigate greed, leading to overexposure. Succumbing to these emotions often results in decisions misaligned with one's strategy and goals. Overconfidence, too, can be a nemesis. Past successes, while encouraging, shouldn't lead to complacency. Every investment decision must be rooted in present contexts and future projections, not past glories. An ever-curious, humble approach often yields the most consistent results. Information overload, especially in today's digital age, can also muddle decisions. While being informed is crucial, it's equally vital to filter out noise. Identifying trustworthy sources, prioritizing quality over quantity, and discerning between fact and opinion are essential skills for modern investors. Long-term versus short-term investing. In the investment realm, time horizons play pivotal roles. While some investors thrive on daily trades, capitalizing on minute price fluctuations, others adopt a marathon approach, focusing on long-term growth and value. Short-term trading, characterized by frequent buy and sell actions, demands constant vigilance. Here, market timing is critical. It's about anticipating short-term trends, reacting to news, and leveraging tools like technical analysis to predict price movements. Long-term investing, on the other hand, is anchored in patience. It's about identifying fundamentally robust companies or assets and holding on to them through market cycles. Historical data often showcases that, over extended periods, markets tend to rise, rewarding patient investors. However, either approach is superior universally. Each caters to different temperaments, skill sets, and goals. While short-term trading might offer quick returns, it also carries higher risks and demands more time. Long-term investing, though potentially slower, often presents more predictable, stable outcomes. Global investing, beyond borders. Today's investor isn't bound by geography. The world, with its plethora of markets and opportunities, awaits. From emerging economies presenting high growth potential to established markets offering stability, global investing widens horizons and diversifies portfolios. Investing internationally, however, introduces unique challenges. Currency fluctuations, political landscapes, and diverse economic indicators influence non-domestic investments. A thriving company in one country might face headwinds due to broader geopolitical or economic issues. Cultural nuances, too, play roles. Consumer behaviors, business etiquettes, and market dynamics can vary drastically across regions. Successful global investors often immerse themselves in these cultures, understanding local contexts to make informed decisions. Yet, the rewards of global investing often outweigh the challenges. It mitigates risks associated with domestic downturns, offers exposure to global growth stories, and provides a holistic view of the financial world. In essence, it transforms an investor from a regional player to a global market participant. Continuous learning and adaptability. The financial realm, with its ever-shifting paradigms, rewards the adaptive. Yesterday's strategies might not yield today's returns. Thus, continuous learning isn't a luxury, it's a necessity for consistent success. Financial literature, from books to journals, offers invaluable insights. These resources delve deep into market psychology, strategy formulation, and asset analysis, refining an investor's knowledge and approach. Peer interactions, too, play crucial roles. Investment clubs, seminars, and workshops foster exchanges of ideas and experiences. Hearing diverse perspectives, understanding different strategies, and analyzing varied success and failure stories enrich the investment journey. Ultimately, the stock market is a reflection of life itself. It's unpredictable, challenging, yet immensely rewarding for those willing to evolve. Embracing change, staying curious, and continuously honing one's skills are the cornerstones of lasting investment success. And that is the end of our video. The stock market, with its vast tapestry of stories, aspirations, and lessons, beckons. As you embark or continue this journey, may your strategies be sound, your convictions strong, and your rewards plentiful. Welcome to the financial jungle.